Hi everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday the 9th of August. There is some evidence that a low may be in place. There's a 90% down day followed 3 days later by an 80% up day. There's a long lower wick on the weekly candlestick, closure of the last gap, so it's an exhaustion gap, and there is bullish divergence still between both of price and the AD line in VIX. The next target for upward movement is 3336. However, we don't have a 90% upward day, so that's the strongest piece of evidence, or rather lack of evidence, which may favour a bearish outlook. If price does fall to a new low below 287361, that would indicate the alternate may be correct, and if that happens, the target for downward movement to end would be at 2663. I have at the weekly chart level two wave counts. They're the same with the exception of the degree of labelling, and at the daily chart level I'm looking at this movement in two different ways. This is my wave count at the weekly chart level. It sees the S&P in a big 5-step forward pattern. It's called an impulse, and it's the simplest Elliott wave structure. 1 is off to the left of the chart, 2, 3, 4 and 5 is underway. When we label this impulse beginning in March 2009 like so, with the first trend line, and we draw a trend channel with the first trend line drawn from the end of 1, which I think is September 2014, to the end of 3 here, and then we place a parallel copy on 2, it perfectly shows where 4 found support. So because you can't see 1 on this chart, it looks like this channel is drawn from 2 to 4. With a copy up here. That's not so. It's drawn from 1 to 3 with a copy on 2. And so because 4 perfectly found support at the lower edge of that channel, it indicates that the labelling of 1, 2, 3 and 4 is correct. And what that means is 4 ends here and 5 begins here. There's an important implication to that. There is a core Elliott wave rule stating a third wave within an impulse may not be the shortest actionary wave. Here, cycle wave 3 is shorter than cycle wave 1, and so for that core rule to be met, cycle wave 5 may not be longer than equality in length with 3. This is the limit for the bull market for this Elliott wave count. Cycle 5 must subdivide as a 5-wave impulse. So far within it, 1 and 2 may be complete and 3 may be beginning. Look now at the structure of cycle 5 on the daily chart, with the end of cycle 4 is this point down here. Here's primary 1 and 2, and now within primary 3, intermediate waves 1 and 2, and now a target for intermediate wave 3. When that's done, intermediate wave 4 must unfold and remain above first wave price territory, and then intermediate 5 may take price up to the target for primary wave 3, and then primary 4 needs to unfold and remain above primary 1 price territory, and finally primary 5 to end the whole structure at or before this limit. So each of these third waves of intermediate waves 3 and primary waves 3 may only subdivide as simple 5-wave impulses, meeting all core Elliott wave rules. The third wave may not be the shortest, the fourth wave may not move into first wave price territory, and the second wave may not move beyond the start of the first wave. The invalidation point for this main daily wave count is higher than the alternate. At the hourly chart level, here's the end of intermediate wave 2 and the beginning of intermediate wave 3. Minor wave 1 within intermediate wave 3 may be incomplete, with minute 1 an expanded flat for minute 2. Minute 3, a zigzag for minute 4 may be over here, or it could continue further sideways as a flat or possibly a combination or a triangle. That's certainly possible. It may not move into wave 1 price territory below the short-term invalidation point. As soon as minute 5 has made a new high above the end of 3, it would have avoided a truncation, and as soon as that happens, look out, minor wave 1 could be over. At that stage, remove the short-term invalidation point and use the longer-term invalidation point. Minor wave 2 may not move beyond the start of wave 1. And so intermediate wave 3 should take several weeks, subdividing as an impulse at minor degree, 1, 2, 3, 4, 5. We can have confidence now only with a new all-time high. But if we see further strength and upward movement, then I would have confidence in this wave count, and if it is strong enough, then I may discard the alternate. At the daily chart level, this wave count is the same as the first up to this low and this high, still seeing primary wave 1 complete over here. And now what if primary wave 2 was not over? What if this downward movement last week was the start of a deeper pullback at primary degree? Primary wave 1 could be over here, and primary wave 2 could be continuing as an expanded flat correction. They subdivide 3, 3, 5. And the B wave within an expanded flat has a common range of 1 to 1.38 times the length of the A wave. And this B wave here would be 1.31 times the length of its A wave. That's nicely within the common range. And so this is a valid wave count still. It just doesn't at the end of the week have as much support from classic technical analysis, but it is valid. This is the risk here. Primary wave 2 may not move beyond the start of primary 1 below this invalidation point, which is the same as on the weekly chart. Within intermediate wave C, it must subdivide as a 5-wave structure. Expanded flat subdivide 3, 3, 5. And so within intermediate C, 1 may be over here, 2 should be over, and now a third wave down could be beginning next week. And so this wave count expects not just downward movement, but an increase in downward momentum next week as a third wave unfolds lower. If we see a new low below this point, then I will have some confidence in this wave count for next week. When minor 3 is complete, minor 4, a short bounce to last just a few days, must remain below first wave price territory, and then a final fifth wave down toward the target. For intermediate wave C to reach 1.618 times the length of intermediate A. When minor waves 3 and 4 within intermediate wave C may be complete, then I can also calculate the target at minor degree. At that stage it might change or it may widen to a small zone. If price gets down to this target and just keeps on falling, then the next target may be the 0.618 Fibonacci ratio of primary wave 1, about 2579. Primary 2 may not move beyond the start of primary 1 below the invalidation point. At the hourly chart level, here's the end of minor 1, and a zigzag could be complete here for minor 2. Minor 3 must subdivide as an impulse. So far it may have 1, 2, and needing a third wave down, and so this wave count now has 2 third waves beginning to move lower. It should be expecting some quite strong downward movement when markets open next week. However, minor wave 2 could continue higher as a double zigzag. It's fallen only slightly short of the 0.618 Fibonacci ratio of minor 1. If it does continue higher, it may not move beyond the start of minor wave 1. At the weekly chart level, this is the same as the first weekly count, except I've moved the degree of labelling all down 1 degree. The implication is not important until the structure of this final fifth wave, whether it be primary or cycle degree beginning here, is complete, and that's many months away. At the weekly chart level, last week there was a very strong bearish engulfing candlestick pattern, and it had support from volume actively pushing price lower, told us to expect more downward movement. We've got that now. The bearishness here may now be resolved. This long lower wick of this green weekly candlestick suggests bullishness at the end of the week. I'm not going to read this as a hammer candlestick pattern because it's not coming at the end of a downward trend. I don't think just one prior candlestick constitutes an actual trend, but the long lower wick is bullish. That does have bullish implications. I'll look out now for support about 28.75, resistance above 29.40, and then next resistance obviously about the last all-time high, about 3025. On balance, volume remains range bound. There's no signal this week. RSI is in neutral territory, plenty of room for price to rise or fall. ADX is declining again. The DX lines have been whipsawing somewhat for a while now. and MACD is neutral at the weekly chart level. What about the daily chart? Here's that strong drop, and the last day down to the low was a 90% down day. The S&P often will form V-like bottoms with a 90% or near to it downward day, followed immediately or soon after by an 90% or near to it up day. That's not quite the case yet. We have an 80% up day, not strong enough to be a 90% up day. And so if we see a 90% up day, then I will have a lot more confidence that there's a low down here. But so far there is reasonable strength coming up off the low now, and a couple of long lower bullish wicks. Here's a good example. Although it didn't happen at the low, there was a 90% down day here. Here was an 80% up day, still more downward movement, and now we got an 89% up day and a strong bullish candlestick pattern, and that told us there was finally a low in place. We could be getting some more downward movement again. This could happen again. We could have another repeat of that kind of behavior again. That's possible. Just a note, this is not a bullish candlestick reversal pattern here. This long bearish candlestick followed by an inside day with a smaller green bullish candlestick is not a harami pattern. A harami pattern needs the second candlestick in the pattern to be a spinning top, and the real body of this candlestick is not small enough to be a spinning top, so this is not a bullish candlestick reversal pattern. Volume did offer some support for this bounce, and on the last day, downward movement within the day, the balance of volume was down, does show some decline in volume. So for the very short term, there may be a more bullish a more bullish short-term volume profile. ADX declining, telling us the previous downward trend may now have ended. ATR increasing as price falls, that's normal behavior for this market. On balance volume constrained, not giving us a new signal either way. RSI is neutral. There's still room for price to fall further, but it did reach oversold at the low. And so that's another small piece of information to point that this may have a low in place down here. MACD is full bore bearish still, and stochastics in neutral territory. The AD line last week had bullish divergence with price. That bullish divergence implication may still remain. There is no new divergence this week, but as yet the bullish divergence between price and the AD line from last week has not been followed by any upward movement. For the short term, Friday's inside day saw on overall the balance of volume down, the candlestick is red, price moved down within the session, the AD line declines. Downward movement within the session had support from declining market breadth, but neither have made new short-term lows. There is no new divergence. The last divergence noted here at the daily chart level between price and the AD line is mid-term bullish divergence. Price was falling faster than market breadth. The downward movement from price did not have support from a corresponding decline in market breadth. This divergence is bullish and supports the view that we may have a low in place here. Between price and inverted VIX for the week, both have moved lower. There is no new divergence. There is still mid-term bearish divergence and longer-term bearish divergence. This has been developing now for many, many months. It may continue yet to develop. The S&P, when it forms tops, it's a slow, long, drawn-out process, and inverted VIX may be one of the earliest warning signs of this whole structure, or the bull market coming to an end. This can develop still further over several more months. But at the short-term level, the daily chart level, for price and inverted VIX, price has moved lower within Friday's session, as has inverted VIX. It's not falling any faster than price. There is no new short-term divergence. At Thursday's high, inverted VIX made a new high above the prior high of the 2nd of August, but price didn't quite manage to do so. I am reading this short-term divergence here as bullish, and supporting the view that price is going to move above this point here. It hasn't done so yet. Between the lows, though, there is bearish divergence. I am not going to give this as much weight as I am going to give bearish divergence between price and the AD line, though. That does tend to be a little bit more reliable. An inverted VIX may be an earlier warning. That's all from me with your S&P analysis. I hope all our members are having an awesome weekend.